Okay, so this is the 2015 ratios question. The first part of it, part A, is quite straightforward. The last part, part C, is a standard question about the limitations of ratio analysis. The tricky part is this middle part, the report, which is going to have an impact on lots of areas, but we'll see that when we get to it. This is one to pay particular attention to because it's hard to build up a bit of notes. It's very specific information that gives you clues as to what you need to write about. So, as I said, we'll look at that in a bit. First thing, as always, highlight the name of the company and the industry that it's in. Work out your 5% preference shares. So 5% of 100,000 is 5,000. Just check net profit and interest is before it. That's the way we want it to be. And that makes it straightforward to manage. So you'll be asked your 5 ratios. You'll see, as I said, they're becoming standardized over the years. You're not seeing too many new ones in part A. So you've got your, if the answer is 1 at the start, so that's the opening stock if the rate of stock turnover is 12 based on average stock. So you need to write down the formula. So the rate of stock turnover is cost of sales over, I don't know why I wrote over, cost of sales over average stock. So cost of sales over average stock is equal to 12. So therefore 12 times average stock is equal to cost of sales. Now cost of sales is 720. So 12 times average stock is equal to 720. So average stock has to be 60,000. Now you have the closing stock. And the closing stock is 51,500. That's 8,500 below 60,000. So therefore, the opening stock has to be 8,500 above 60,000 if it's an average. Remember, an average of 2 numbers is the number in the middle between them. So you could just do it that way. And you know it's 68.5. Or opening stock plus closing stock over 2 is 60,000. So opening stock plus closing stock is equal to 60,000 by 2, which is 120,000. Opening stock plus 51,500 is 120,000. So therefore opening stock is 120 minus 51.5, which is 68.5. So straightforward enough. You can have a look back at that yourselves. Earnings per share, net profit. It's earnings per share. I don't know why I wrote down P. I'd say I just copied this from a different slide. But it's net profit minus preference dividend over issued ordinary shares. So net profit is 54,000. Preference dividend is 5. So 54 minus 5 over the 650 is 7.54. Dividend yield, 2-part 1 here. Dividend yield is dividends per share over the market value of 1 share. Of course, dividends per share is ordinary dividend over issued ordinary shares. And ordinary dividend is total dividend minus preference dividend. So the total dividend is 44. Preference is 5. So we've got 39 over the 650, which is 6 cents. Then your dividend yield, 6 cents over the 95 cents, the price of the share, 6.32. Price earnings. Now we've worked out the EPS already, so it's price over EPS. So 95 over 7.54. That works out all the way back here. So 95 over 7.54 is 12.6. That's it, done. And then interest cover, net profit plus interest over interest. So net profit is 54, interest is 14. So 68 over 14 is 4.86 times. So you fly through that and then you get to this report. As I said, the report is the exciting part of this question. So there's not too much difference. You have to write it on the basis of should this guy buy the shares. So he's an investor and he's considering buying 150,000 of the already issued shares. So they're not new shares, because if they were new shares, that would change the gearing. That would be something you would have to look at. If they're existing shares, they're of this 650 already. Now he's buying them at 90 cent each, which is cheaper than what they are at the moment, 95 cent each. But he's going to use 50,000 of his own money, and he's going to borrow the remainder at 9%. So if he's not getting better than 9% return on his profitability, and he's not getting better than 9% on his dividend yield, and if he's not getting better than 9 cents per share on his earnings, on his dividends per share, well, then that could be a problem for him. So that 9% is going to be very important when we look at our dividends in particular. He's consulted me, Barry Ryan, as financial consultant for his advice. Write a report to Tommy your recommendations. I would suggest you follow a very simple report to Tom Murphy from Barry Ryan and give it a date. Now I know you can just check straight away at the start, right? His earnings per share is 9.1 and now it's 6 point something. The share price gone from 97 to 95. This isn't going to be a good idea. Okay, but obviously we'll make sure that we're putting it in that you're going to, at the end of the question, advise him against buying the shares or to buy the shares. But I've done it already, so I know it's against. So, we don't know where a quick PLC. I was looking at a different question initially. So, this is GJ is a profitable company with a net profit of 54,000. Following our profitability line as always. We have a return on capital employed 2014 of 6.97. So I would have had to work out my return on capital employed because I didn't have to do it in the ratio. So that's net profit minus preference dividend over capital employed. So 54 minus 5. So 49 over 975 will give you the 6.97. And it's come down, which is worrying, from 8.2%, which is a negative trend. So it's above the risk-free rate of return, but it's below the borrowing rate. So it's below the 7% borrowing rate. Not what he's borrowing at, but what the company is borrowing at. So it's below the borrowing rate of 6%. I should say, it's below the borrowing rate of 7%. Sorry. A lot of typos, as you can see. So that's obviously 7%. Which indicates they're not making efficient use of their resources. So shareholders would not be happy with that if the trend continues. Okay, so that's our profitability. I would put in the return on equity funds, which I worked out to be 7.2%. That's very low. And it's very low, especially in relation to the interest rate. Okay, so you might even compare it to the interest rate if you wanted there, just to be sure. All right, so that's our profitability. Our dividend policy then, and this is where the few little tricky parts come in. So you see there's a lot in this. So the dividends per share is 6 cents, which I worked out, down from 8 cents, a negative trend. Tom would now I'm putting in what you would expect, what he would expect to get in dividends. So if he's owning 150,000 shares and he's got a dividend per share of 6 cents, 6 cents by 150,000 shares is 9,000. So when they give you a specific number of shares that you're buying, it's good to work out what the total dividend would be. Okay, I might make up a set of notes on this type of one for you. So Tom could expect to receive 9,000. This doesn't seem like a bad return. The dividend yield is 6.32, which is down from 8.25, a negative trend. And again, always state what dividend yield is. It's the interest earned from owning shares. Okay, it's above the risk-free rate of return, but it's falling. And it's also well below the borrowing rate required to purchase the shares. And the borrowing rate is 9%. So the return you're getting is below the 9%. Okay, so that's something to be aware of. All right, so you're comparing the yield to that. Now, he will be borrowing 85,000. How do I know that? Well, he's buying 150,000 shares at 95 cents or at 90 cents. So 90 by 150 is 135,000. He's putting his own money in, so he's borrowing 85,000. Okay, he's paying interest at 9%. So 9% of 85,000 is 7,650. So he's getting 9,000, but he has to pay 7,650 in interest. So he's still making a positive return. But when you take into account the fact that he's not getting his 2% interest that he could get if from leaving his money, okay, that'd be another €1,000. He's really not getting anything of substance back from investing. You'd move on to the dividend cover then, so it's 1.26 times. Last year's dividend cover was 1.14, so it's positive. So you could say that is positive, but it's still very, very low. Okay, it's still very low, and that would be a concern. All right, so that's my dividend cover, and then I did my overall return. So again, 7.94%, 6.32 by 1.26. Now, I wasn't in a position to work out last year, so I just compared it to the borrowing rate of 9%. And again, it's below that. All negative so far. And probably get worse as we go to liquidity. So work out the asset test ratio. Current assets minus closing stock. So 131,500 minus 51,500. And compare that to your 121,500 and you get 0.66 is to 1. And that's down from 0.9 is to 1, which is a negative trend, and it's below the ideal of 1 is to 1. Big issues here, liquidity problems. So GJ has a serious liquidity problem, as they have 61 cent or 66 cent of liquid assets for every 1 year of short-term debt, and they will have difficulty paying their short-term debts as they fall due. Remember what I said then when we're talking about liquidity as shareholders. A couple of things we need to be, or one thing we need to be aware of: poor liquidity reduces the chance of a dividend being paid. Okay, so we put that in. Now, bigger concerns for me is there's a serious question mark over whether the company can remain a going concern. I just wanted to put in that phrase going concern, which is one of the fundamental concepts of accounting. So if it's not a going concern, you could lose all of your investment. Okay, so that's our liquidity done. Nothing new in that really. Gearing and interest cover, nothing new in this. So gearing of 30.77, and it's only up slightly, which is a negative trend, but the gearing is quite good. So we can say that it's worsened, but it's still a lowly geared company, and it's funded more through equity than long-term debt, and it's not dependent on outside borrowing. So that's all positive. Interest cover 4.86 times, which is down from 6 times, which is a negative trend. So explain what interest cover is. It's the number of times that interest can be paid out of profits. Now, 4.86 times is high, but when you put it along with your falling profits and your poor liquidity, that would be concerning for potential investors. Okay, so that's that in. So even though the gearing is low, we can say they're still in a poor position. Now the market value of shares. So shares have gone from 97 down to 95. Now you're getting them at a discount, and I probably should have put that in. Obviously that should say in 2013, and that's a negative trend. So it's a 2% decrease in the share price. So markets don't have confidence, and that will concern shareholders. Now, at that point, we need to say, well, how much is he buying? He's buying 150,000 of the shares. So he's buying 150 out of 650,000 shares, which is 23% of the company. So he's buying shares that are falling in value. He's going to own 23% of the company, and the company might no longer exist in a period of time. So he's taking on serious risk. Okay, always then talk about your price earnings ratio. 12.6, which is up from 10.66 years in 2013, which means that shareholders will recover their investments in a longer time period, which is worrying. I will that should say 2013. I'll update them before I post them. That is worrying. Last thing, I want a sector. Now, they're a manufacturer in the food processing sector. The food processing sector is obviously a good industry to be in, so this is tricky for me to come up with short-term positives and negatives. So I want two negatives and a positive. So in the short term, the industry can expect to suffer due to Brexit, just put it that, and the increased costs associated. And then I copied and pasted that from a previous question. So in the long term, we could say that food production is under pressure from production in other jurisdictions, which could impact GJ. Again, I'll put that in before I post. Part C then, you're asked about the limitations of ratio analysis as a financial analysis technique. You need two limitations really. So the limitations are it's backward looking. So into financial analysis is you're trying to predict the future by looking at the past. That's its big limitation. So you're looking at historical data and trying to predict the future. So you're only ever guessing as to what's going to happen in the future. There's no standards, so each company can use its own way of doing ratios. They can use different ratios, you can do all sorts of things. So it can make it difficult to compare companies. It doesn't say anything about other aspects of the business. It just looks at the finances. It doesn't say, is the managing director going to retire next year? How is staff morale? Has there been a flood? It doesn't say anything about anything other than financial positions. They don't take into account things like seasonality that can affect profitability. So you could be really unprofitable, but it could be because there's been a drought. So it doesn't really say any of those things. So that's our financial analysis, or that's our part C done. Okay, I will correct the little errors in the answer and I'll post both up to you this evening.